The U.S. housing market is one that many people keep their eyes on, and for good reason. In recent months, home prices have been on a steady decline, marking the sixth consecutive month of falls since reaching its peak in July 2021. According to new Case-Shiller numbers, values have gone straight down, dropping by a total of 4.4%. While the decline in home prices may not seem like a lot, there are a few things to consider before jumping to any conclusions. For starters, home prices have been on a significant rise since 2020. As such, the 4.4% decline is relatively small when compared to the gains made over the past few years. For example, let's say you were looking at a house at the start of 2020 that cost $300,000. Using the Case-Shiller index as a baseline, this same house would have grown in value to $435,000 by last summer. Therefore, even with the current decline in prices, we are still a far cry from those pre-pandemic levels. However, there is evidence that suggests this decline is not just a small blip on the radar. Going back to 1987, there have only been 3 instances where we've had 6 straight months of declines. One was in the early 90s during the hidden crash, and of course the other was in 2008, which was the worst real estate decline since the Great Depression. This indicates that something more significant could be happening. The pace at which the real estate market changes, whether it's up or down, is not always fully understood by most buyers. While it may be frustrating to hear, things don't happen as they do in the movies. During the last crash nearly 15 years ago, things fell apart over a period of years, not days or months. The Case-Shiller index peaked in July of 2006 and then fell 32 months in a row before doing a bit of a waving pattern until February of 2012. At this point, it had been 5 years and 7 months since the start of the downturn. The whole crash was a very slow-moving train wreck. Just think about where you were 5 years and 7 months ago. That takes us back to August 2017. Now imagine this whole time prices were declining. This was 2008, and despite this extremely long period of diminishing values, the median price of a home in America only declined by about 27%. So, what can we expect going forward? If 2008 was the worst housing crash in modern American history, what can we realistically expect this time around? While the evidence suggests that this pattern will continue in the near future, the big question remains: how low can we go? To figure out where home prices might end up if we experience another crash, we can look at the Fred data and compare the 2008 downturn to the one we're currently experiencing. One thing you'll notice is that the run-up to the peak was more extreme this time around, with numbers rapidly jumping up around March 2020. Now, the important thing to notice about this chart is that it proves that as things stand today, we are worse off than in 2008. That's not an exaggeration either. If we zoom in on the peak, you can see that the 6 months following July 2006, which was when the last crash started, we were down around 1.1%. In comparison, today, we find ourselves down 4.4%. This means that if we are indeed at the start of a new crash, we are starting at 4 times worse than last time. Just take a look at that 2023 line in comparison to 2006. When you factor in just how little time has passed since this point, we have never experienced a real estate market like this one on a national level. The pace of this decline is unprecedented, so while it feels like nothing, historically speaking, it's record-breaking. The U.S. housing market is no stranger to up and downs. The subprime mortgage crisis in 2008 caused a significant crash in the housing market, but the market eventually recovered. However, the current state of the U.S. housing market is worrisome. With the decline in home prices, there are concerns that the country might experience another housing crash. While it may not seem like a big deal at first glance, when you compare it to past declines, it becomes evident that we are heading towards uncharted waters. One factor that is contributing to this decline is interest rates. The majority of homebuyers rely on mortgages to finance their purchases, and interest rates play a significant role in determining how much they can afford to pay each month. Since 2020, the average monthly payment for American buyers has more than doubled, going from around $1,200 to $2,486. This increase in monthly payments has made it more difficult for people to buy homes, especially for young people already struggling with student debt and other financial burdens.